Assalamu alaikum. In this video lecture, we'll be discussing capital budgeting lesson 3 on the discounted methods of evaluating capital investment alternatives. So for the discounted cash flow techniques, these are the advantages. First, it is more reliable because the time value of money is taken into account. So it is more realistic because, of course, the money or the funds that finances these capital projects are sometimes loaned or actually have equal rates of return. Okay. So second, income over the entire life of the project is considered. Okay, so this is unlike the payback period that income after the payback period is not considered or ignored. So number three, it is more objective and relevant because it focuses on cash flows. So are the advantages. However, these are also its disadvantages. So first, it is not easily understood. So discounted cash flow techniques are usually complicated for beginners, but actually as you have a full grasp of the concept, it becomes easier. Second, it is again more complex and difficult to apply. Third, it requires detailed long-term forecast of incremental cash flow data. And fourth, it requires the predetermination of the cost of capital or the discounted rate to be used. So without this cost of capital or the discounted rate, you cannot compute for the present value. And that complicates capital budgeting if you will start with a computation of the cost of capital. So if the problem is very comprehensive such that you will be the one to compute for the cost of capital, which will be the cost that will be used in discounting the inflows, then that is a pretty long and tedious solving. Okay. So we have here the formula. For first, we have the first discounted model, the net present value. So what is the formula of our net present value? So net present value is equal to present value of cash inflows, and that is the annual cash flows plus the terminal cash flows, which could include the salvage value of the asset or the project and working capital released, if any, less the initial investment. So that is our net present value. So or in other words, PVCI less COI, cost of investment, is equal to NPV. Okay, so what is our decision rule? Our decision rule is as follows. If our net present value is equal to or greater than 0, then we accept. Then if it is lesser than 0, then reject. Okay, so net present value means that our a positive net present value means that our present value of cash inflows are greater than our cost of investment. That's why positive. The answer, for example, 2 minus 1 is equal to positive 1. No? Okay, so that means our benefits are heavier than the cost. No? Okay, so if our cash inflows are uniform, our formula would be cash inflows multiplied by present value of annuity interest factor. Okay, so that will be the factor that we will use to discount our cash inflows to get the PVCI or the present value of cash inflows. So if our cash inflows are not equal, so you get the cash inflow of year 1 multiplied by the present value interest factor for one single payment on year 1 plus the cash inflow on year 2 multiplied by its present value interest factor, and so on and so forth. Okay, so we have here a sample problem. Okay, Maria Manufacturing has an investment opportunity to embark on a project where yearly revenues for 5 years are to be 400,000 and operating cost of 104,800. So the project life is 5 years, and the yearly revenue is 400,000, operating cost is 104,800. The equipment cost 1 million, and straight-line depreciation will be used for book and tax purposes. No salvage value is expected, and the company has 40% marginal tax rate and 10% cost of capital. The equipment manufacturers offered a delayed payment plan of 560,500 per year at the end of the first and second years. There will be no changes in working capital. The present value of annuity of 1 for 5 periods is 3.7908 at 10%. The present value of 1 at the end of each period at 10% are as follows. Question: what is the net present value if the equipment were purchased? So first, let's get the cash flow before tax. So we have the annual revenues of 100,000. Then we deduct the cash operating cost, 104,800. So therefore, we have cash flow before tax of 295,200. Let's deduct the depreciation, and that is determined by 1 million divided by 5 years, so 200,000. So we have our income before tax of 95,200. Deduct further our tax, so we have here our net income net of tax, 57,120. So we add back our depreciation, 200,000. So we have after-tax cash flow of 257,120. So we will get the present value of this annual cash flow using the present value factor of annuity of 10%, and that is 3.7908 as given in the problem. So we will multiply 257,120 by times 3.7908. So we get 974,690. So less our cost of investment 1 million. So we have a negative net present value of 25,310. So therefore, all our benefits for these projects would amount only to 974,690. And that is to be recovered for 5 years. And our investment today will be 1 million. So what is the sense of pursuing this project? So therefore, we reject this project because it has a negative net present value. A self-check question. So this is self-check question number 1. Okay, so for our second discounted model, we have the Profitability Index. So this technique is the ratio of the total present value of future cash inflows to our initial investment. So that's why our formula is present value of cash inflows divided by present value of net investment. Okay, so PVCI divided by COI. So the best use of the Profitability Index is to rank projects, particularly those with varying amounts of investment. So how do we rank project? What is our decision? Our decision rule first is if our Profitability Index is equal to or greater than 1, we accept. Equal, that means break even, no? Because that's equal. The PVCI is equal to our COI. And of course, the greater than 1, the better. Accept. If our Profitability Index is less than 1, we reject. Okay, that means there is no benefit. Our cost outweighs our benefit. So what's the use again of investing in that project? So if we rank starting from the highest Profitability Index down to the lowest. So we have here our problem. Sophia Industries has designated 800,000 for capital investment expenditures during the upcoming year. Its cost of capital is 14%. Any unused funds will earn the cost of capital rate. The following investment opportunities, along with the required investment and estimated NPVs, have been identified on the table below, on the table here that will be given later. So let's compute for the profitability index of each project and determine which of the projects should be accepted considering the limit on funds available. So again, we only have 800,000. Okay, so we have here Alpha, Bravo, Charlie, Delta, Echo. So we are evaluating 5 projects with different net investments. So our question is, which among these projects will be accepted considering we have 800,000 capital budget only. Okay, so first we have here the NPV. So as what we know, NPV is just the difference between PVCI and our cost of investment. So if we have here our cost of investment and we have here an NPV, we can just work it back to get our PVCI. So for example, for Alpha, we have net present value of 22,000, net cost of investment of 200,000. So therefore, our present value of cash inflows is 222,000. Very easy, right? Okay, so then just continue. So let's say Bravo, we have net present value of 21,000 and plus the net cost of investment 275,000, and that will give us present value of cash inflows of 296,000. Okay, 296,000, and so on and so forth. So if this is a negative, so you have to deduct this. Okay, so negative 19,000 plus 190,000, so you'll get 171,000 PVCI, present value of cash inflows. So now we will get, if you can get the PVCI, we can get now the profitability index. So for example, here in Alpha, so we have for Alpha 222,000 divided by 222,000 divided by 200,000. So we have 1.11. Okay, for Bravo, we have 296,000 divided by 275,000, we get 1.076. So you just do the same procedure. For Charlie, we have 156,000 divided by 150,000, 1.04. For Delta, we have 171,000 divided by 190,000, we get 0.90. For Echo, we have 540,000 divided by 500,000, we have 1.08. So of course, we will, since we have a 5 projects, let's determine which among them are acceptable. So we have here for Alpha, we accept greater than 1 accept, greater than 1 accept, less than 1 reject, greater than 1 accept. But what is our decision? So we have our limit here of 800,000. So therefore, our priority would be from the highest profitability index down to the lowest. So we have, first, we have 1.11, and that's amounting to 200,000. So that's our first priority, Alpha, Project Alpha. Then we have 1.08, Echo. Okay, that's our next priority. So therefore, we have Alpha and Echo for our project, because these two projects already are would amount to 700,000 already, and the funds cannot cater any additional project. But again, that is based on the quantitative number alone. But if there are qualitative information supplemented in this project, maybe there are some qualitative benefits for Bravo and Charlie, and management can consider them. Okay. So this is now time for soft check question number 2. Okay, so we have here our discounted payback period, or what we call the break-even time period. So this same principle applies with the conventional payback period, but our payback period is computed using the discounted cash flows here rather than the actual cash flows. That's why discounted payback period. So the same formula, our present value of cash flow can be determined by multiplying our annual cash flow by the present value of interest factor. So we have here our answer, our table. So for cash flow for periods, you can see uniform cash flows, right? Okay, so you can do the long cut so that you can understand it. Okay, so you just multiply that with the discounted factor. So we have the discounted cash flow. So period recovered 1. So the same, 25 times 0.8264 equals 2,066,000 another period. So we have here, what is left is, so if we add 2273 plus 2066. Okay. So actually our project cost here is 5 million. Okay. So 5 million project cost. Okay. So we have 2.35 discounted payback period because on the third year, in order to have 5 million, we need 661,000 out of 1,878,000. So we will get 0.35. Okay, so we have here another discounted model. We have IRR, or the internal rate of return. So this is also known as the discounted cash flow rate of return or time adjusted rate of return. So IRR is defined as the rate of return generated by the investment as represented by the cash flows from the project. So converting the cash flows, returns, and absolute amounts into a percentage. This will give the IRR of the project. So it is interesting for NPV. The NPV of the cash flows using the IRR would always be equal to 0. So in other words, at NPV, the cost of capital is the same with the IRR. So since our NPV is 0, right? So our PVCI is equal to our cost of investment. So therefore, our IRR, which is our PVCI, the rate used in discounting our cash inflows, is at IRR, and that would give us 0 NPV. So for the formula, if cash inflows are even, let's compute the present value factor. So actually this is like the payback period. So we have the net investment divided by annual cash returns. Or this is actually, yun. Then we trace the present value annuity interest factor in the table. So if the cash inflows are uneven, we compute for the present value factor. We have the net investment divided by the average annual cash returns. Okay. So second, we trace the present value of annuity interest factor in the table. Then we compute the present value using the present value interest factor table and interpolate to get the exact IRR. So we have here the interpolation formula. Okay, so I know that you are already familiar with this one. Okay, so for the denominator, this is simply the difference between this x and y. And then for the numerator, you can use from the top, from the x to the present value factor that you have derived here, or you can start with the bottom, so it's either way, no? And then multiply by the difference here in the rate. So for example, you are using here 5%, then here 6%, so that's 1%. So you multiply that with the answer here. Okay, you multiply that. Then you either add that if you use from here, the rate here, or you deduct that if you use the rate at the bottom. Okay, so that is how we do interpolation. And this is very important because in our cost of capital, when we compute bonds valuation, we always do interpolation. So we have here a problem. So Jane has an opportunity to invest in a project that will yield 4 annual payments. So 4 annual payments of 12,000 with no salvage value. The first payment will be received in exactly 1 year. Okay, on low risk in projects of this type, Jane requires a return of 6%. Based on this requirement, the project generates a profitability index of 1.03953. So therefore, what are the given here? So we have here the period for the annual payments, the annuity, 12,000. This is the cash flows. We have the 6% required return and the profitability index of 1.03953. Okay, so the present value of 12,000 annuity is found by multiplying 12,000 by the annuity factor associated with 6% interest in 4 years. And that is 3.4651. So in your financial calculator, you can just easily compute for this, or if you are using the scientific calculator, you can actually solve for this one also by 1 plus I raised to negative n, 1 minus answer, then divided by the I. Okay, so you can just do it. Okay, so from the factor, you can get the present value of our cash inflows. We have 41,581.2. So from the information our profitability index, so since our PVCI is 41,581.2, we just divide that with our profitability index of 1.03953. We get initial cost of investment of 40,000. So if we divide 40,000 by the annual cash inflow of 12,000, we have the discount factor associated with the IRR, and that is 3.3333. So this discount factor is associated with an interest rate found in the table. So this is somewhere here. Okay, so 3.33 is in between here. So it lies between 7% and 8%. So take note that we are looking at 4-year time period. Okay, so just look at the table. If the table is given in the problem, so look at the table, the number of years, then look for your discount rate, discount factor associated with your IRR. Okay, that you have the factor, no, the discount factor. Okay, so you interpolate. So using interpolation, the IRR will be approximately 7.72%. Okay, so just do the exercise on the interpolation, no? So from 3.33, then the x here is this one and the y here is this one. So you can try that using interpolation and you get 7.72%. Okay, so time for self-check question number 3. Okay, so we also have here mutually exclusive projects analysis. So in this project, we are faced with a mutually exclusive scenario. Meaning for mutually exclusive, again, if we choose one alternative, it automatically excludes the other alternative. So it's take it or leave it, no? So if we choose one A, it's automatic rejection for B. That is what is meant by mutually exclusive project. So we take into account here the following: the net investment of the project. Second, the net cash flow from operations. So we include tax savings, if any, due to the increased expenses like depreciation and repairs and maintenance expense. And also our terminal cash flows. So all our cash flows in the future period will have to be discounted again at the present to determine their present value. Okay, and we will determine now if it is worth pursuing or not. That's why we need to get their present value today. How much is it worth today? So in cases where one must choose between mutually exclusive investments, NPV and IRR methods may give decisions that contradict each other. Okay, so yung conditions under which contradictory rankings can occur are, especially if A, if projects have different expected lives, B, if the projects have different sizes of investment, and C, the timing of the project's cash flows differ. Okay, so in these cases, our NPV and IRR method may recommend or may rank projects differently. So where do these contradiction results come from? So it is basically on these two reasons. First, the NPV method discounts all cash flows at the cost of capital. So assuming this NPV implicitly assumed that these cash flows can be reinvested at the cost of capital. However, the IRR method implies a reinvestment rate at IRR. So therefore, the implied reinvestment rate will differ from project to project. So in these situations, NPV will prove to be superior over IRR since the cost of capital is a more realistic reinvestment rate. So however, no, IRR remains to be a very favored technique because usually actually from the perspective of the manager, even if it gives IRR of let's say 10%, but the NPV is only amounting to 10,000. So if you compare that with an IRR of 5%, but with an NPV of 1 million, so actually for managers, why would you pursue 10,000 if there is net present value of 1 million? So actually it differs, no? Actually it depends on the appetite of the managers. But generally, NPV is superior in decision making. So we have here actually an example of a mutually exclusive project analysis. So first example is the lease or purchase. So our procedure, let's compare the present value of the net cash outlays under the two alternatives. Then we decide by choosing the alternative that will give us the least cash outflow, because lease cost or the rent cost versus the purchase cost. Okay, so this is just like our short-term or relevant costing, but in this case, we are deciding whether to rent or buy, but on a very long-term basis. This is capital budgeting. So we have here for lease, our relevant cost would be the present value of our annual rent and the present value of annual tax savings on rent. Then we have for purchase alternative, we have the present value of purchase, and that is the acquisition cost, and the present value of annual tax savings on depreciation. So these are the relevant costs in our decision scenario. So we have here our second example, and that is retain or replace. Okay, so again, these are just decision scenarios, but this affects long term, no, and substantial cash capital outlays. For our procedure would be to compare the present value of the net cash outlays under two alternatives, and we decide by choosing the alternative again that will give us the least cash outflow. So for retain alternative, we have this three relevant costs. First, the present value of annual repairs or operating cost. Second, the present value of annual tax savings on repairs or operating cost. And the present value of annual tax savings on depreciation. For replace alternative, we have this following relevant cost. The present value of purchase price, and that is the acquisition cost. No need to multiply with the present value factor. Then we have the present value of gross proceeds from sale of old asset, net of taxes, in case of gain or loss. Then we have the present value of salvage value, the present value of annual tax savings from depreciation, present value of annual operating cost, and the present value of annual tax savings from operating costs.